Hello guys, welcome to a new Forex education video. On this video, we will explain what's the meaning of fundamental analysis. Fundamental analysis is a methodology to forecast and evaluate the movements of a currency pair. We also can use fundamental analysis to forecast the movement of different assets, for example, commodities or derivatives. Traders usually use two methodologies in order to trade. The first one is fundamental analysis, and the second one is called technical analysis. Well, in fundamental analysis, it's very important to know the macroeconomy condition or state of a country or nation. It's also very important to know the central bank different policies and political and social news. Let's take a look at some of the key fundamental economic indicators used by Forex traders. Employment reports, including the unemployment rate, the number of claimants or jobless individuals applying for services, payroll levels, and other job-related data. Trade balance, the difference between a country's imports and exports, which has a direct effect on the demand for that nation's currency. A deficit will mean the country is importing more than exporting, while a surplus will indicate more exports than imports. Current account, one of two components of a nation's balance of payments. The current account is the balance of trade and net cash transfers for a country. A surplus will indicate the value of a country's foreign assets were higher than its debt, while a deficit will indicate the reverse. GDP, changes in a nation's gross domestic product, can have notable effects on that country's currency. A sharp increase in GDP indicates strength in the economy that could stimulate appreciation in its currency, especially if the market anticipates a possible interest rate hike. CPI, the Consumer Price Index, shows the level of prices of products on a consumer level and is a key inflation indicator. Controlling inflation is one of the first mandates of most major central banks, so CPI changes can directly influence monetary policy. An increase in inflation could indicate an interest rate rise, while lower consumer prices will indicate lower benchmark interest rates. PPI, the Producer Price Index, judges what manufacturers are paying for the material before making a finished product. This number affects a nation's currency because a higher PPI suggests higher future consumer inflation, while a lower number indicates the opposite. PMI, the Purchasing Managers Index, surveys the activity of purchasing managers and can be a leading economic indicator. Purchasing managers generally are the first to know of increases or decreases in future production that can indicate strength or weakness in the manufacturing sector. Commodity prices. The price of commodities can have a significant effect on the currencies of both producing and consuming nations and are directly related to inflationary and disinflationary cycles. Lower prices on commodities such as crude oil directly affect the transport and hence cost of goods, thereby lowering inflation numbers, while higher oil prices typically lead to increased transportation costs and higher inflation. National credit quality. Other reasons for reevaluating a nation's currency will be if the nation's credit quality improved or deteriorated according to a major ratings agency, or if it announced an intention to repay or default on its loans.